Hello there, this is James, and you're watching the latest episode of our Primus Live webinar series. Now, before I introduce you to my very special co-host, remember these little episodes are for educational purposes only, and in no way whatsoever should be taken as advice. I always suggest you do your own research and do your own due diligence, and of course, know the risks at hand before entering any trade. Now, let me introduce you to my very special co-host. And of course, by now, she doesn't really need an introduction, but I'll do it anyway. She is Kaya, and she is our head of investment research here at FX Primus. Now, before we were lucky to get her, she was a portfolio and investment manager with exposure to both public and private markets. Before joining us as well, she was a senior associate at a hedge fund in Singapore and a vice president at Bank of America, Merrill Lynch. Let's welcome Kaya.
Hi, good afternoon, James. How are you today? Good to see you.
Good to see you. Pleasure is always mine, as I always say. I'm very good. I'm pleased to say it's been a nice sunny day today, so that's sort of put me in good spirits. And I just have to say, I think orange really suits you. I love that shade of orange on you.
Thank you so much, James.
Good. How's your day been? Have you had a good day?
Day has been good. I would say 2021 has really been sort of a good start to the year. Or we've seen good start to 2021. Markets have been very stable. We've seen a few interesting developments, which we're going to discuss today. And I think we are looking very interesting year ahead.
Definitely. I think so far, so good, shall I say. That's what I can say so far for the year. Today's quite a special episode because we have another guest with us joining our panel today. And I'll give you a quick little introduction on this good person as well. His name is Harry, and he is the team leader of our market analysis team here at FX Primus. Now, Harry, he specializes in technical analysis with a particular focus on price action and risk management. And unfortunately, he is a Tottenham Hotspur fan, so let's feel sorry for him. But anyway, enough of that. Welcome, Harry.
Thank you very much. It's a pleasure to be here.
Excellent, mate. It's great to have you, my friend.
Everyone doing?
We're all good. We're all good. And I say it's an absolute pleasure having you on today's show, buddy. It's really good. And I have to say, I like the tie. You've actually made an effort and put a tie on. Look, you know,
of course, we have to look good.
Absolutely. Absolutely. So should we push ahead with what's happening in the markets?
Let's push ahead. And, firstly, our topic today is candlesticks. Mm-hmm. And we have brought Harry, for this live because he is the expert when it comes to technical analysis at FX Primus. Our clients definitely know his lovely voice, and now you have the pleasure to seeing his face as well. But before we're going to go into the candlesticks and the application, we're going to do a quick update on markets as well. And as I mentioned, 2021 has been interesting so far. We are seeing very strong risk-on sentiment, which is driven by a few developments. So firstly, it's the vaccination efforts that have really sort of gotten us to relatively good place, I would say. And when I say us, I don't mean us in the EU. I'm going to say those in the UK and in the US. So these two countries have reached already respectively 12.8% and 19% vaccination level, which means at least one dose has been given to an adult. Israel and the UAE is, of course, atop of the list, but you could debate a bit about the efficacy of those vaccines because they source from multiple sources, meaning from Russia as well as from China, whereas the developed countries have mostly gone for Pfizer and AstraZeneca ones. So I think that by end of 2021, 75% of population should be vaccinated in the US and in the UK. UK is actually aiming for August, which is, I think, quite aggressive, but looking at the numbers, 300,000 people every day, that's quite remarkable. And US was 1.5 million last week. So a lot of effort done on that space. And talking about equity markets a bit. So the next slide is give us a bit of breakdown about, not the equities market yet, but the economies. So we're seeing that China has really performed well in 2020. And, James, we have had this discussion with you that China was the only large developed economy that actually didn't contract last year. Yes. And moreover, is looking to grow 9.8%. And this is all OECD data. So we're definitely going to see a lot of capital flows going into China. And China did not increase their M2 money supply the same extent that the US did, which explains the strength in Chinese yuan to some extent.
Right.
The inflation data looks weak in Japan, in Europe, as expected. The only sort of large economy to have some sort of inflation should be China again, although they did have deflation, or I should say slowing off inflation last month. And also US has sort of projected to have some sort of inflation. But again, coming back to our topic, James, US CPI data is predominantly rental component, and we are seeing a lot of stagnation in the rentals. Moreover, we are seeing a lot of people actually not being able to pay for their, for their accommodation. So I would be a bit doubtful about US inflation.
Right.
So I do want to touch upon equities markets, which is now the next slide. And we are clearly reaching a level that can be perceived as a bubble by some people. So the Buffett indicator, which is market capitalization to GDP, is now at all-time high at approximately 190%. SPX, which is S&P 500 ETF, NASDAQ, and Russell 2000, all at all-time highs. Most of the sectors are up. So XLK representing technology, XLY consumer discretionary, XHB, which is home builders. We have communications and technology all-time high. While the sectors that have had strong recoveries are predominantly US banks, financials, industrials, and also healthcare. So the fact that you have such sort of simultaneous growth in so many equity sectors shows that there isn't much rotation happening. Capital is just flowing sort of everywhere. And we're seeing VIX at 20.8 now. So VIX spiked to 37 a couple of weeks ago when we had this GameStop short squeeze, but now it has come back to lower levels. And once we break 20 with VIX, this is very strong resistance that has been, very strong support that has been in place since March last year. If we break that 20, I think there's a chance that VIX will even go lower, and VIX sort of moving inversely with equities markets could see equities reaching another all-time high. And your favorite?
Oh, yeah, I knew this was coming. Before we go on to my favorite, just want to say, so like I say, we've spoken several times in previous episodes about the bubble finally bursting. And are you sort of thinking now we are really seeing potentially a hint that it is very much on the horizon now?
James, it's hard to say, because it seems to me that this sort of euphoria is driven by a few things. First of all, everybody has already priced in the herd immunity.
Yes.
Seems that we have priced in the second stimulus coming out from the US, which I would say is quite unlikely to go through, and I will, discuss this a bit later. So, given that we have already priced in so many different positive catalysts, we have very little room for any error. And the moment something goes wrong, I have a feeling that the markets might have a quite significant pullback. I'm not going to use the word crash, because crashes such we saw in March maybe happen once in a decade. However, having said that, I think that once we have substantial negative data point coming out, we could see pullback. And when I say substantial, you saw the job report, NFPs for January, 49,000 jobs added. At the same time, 400,000 people left the workforce. This is not strong job data by any means. We're
just lucky. Like I said, we've had showed on previous shows, the market is not paying so much attention at the moment to fundamentals. But as you rightfully said, and I totally agree with you on this, a lot of the good news, a lot of the euphoria, the excitement which we saw come November, when the market, we admit it, we've been on a bull run for quite a while now, but the big sort of rush of the bull run happened in November with the excitement of a vaccine on its way. And then it sort of rose again, December, early January again with the stimulus package. And actually, I feel like you said, these have already been priced in. What other good news is there to come other than actually, guys, we're not out of the woods yet. There is more negative stuff, like the job data, like you rightfully said. So, with no other good news to come, and only technically maybe potential bad news to come, there is a good possibility that we could see a complete, not complete down, collapse, like you said, but a very big shift in market direction. So I totally agree with you on that.
Yeah, and I will just add one sort of potential outcome, which is the amount of debt being issued in the US during the first half of 2021 is 1.9 trillion, obviously, which is a stimulus package. At this point, it's mostly the Federal Reserve Bank who's purchasing the assets that are issued by the federal government, right?
Yes.
And the Fed chair has said, okay, he never says stuff clearly, I should say, but he has expressed his views that the Fed will not increase their current asset purchases, so 120 billion on a monthly basis. If you have such huge supply, but the demand at the main buyer level remains the same, this means that, by natural extension, somebody else has to absorb the rest of that debt, right? And I would say that could be a potential market event at some point when all that debt actually hits the market. Yes. Somebody's going to have to absorb. Maybe the global market participants don't want to absorb that at this point, because if you think about the hedging cost, for Japanese investors, it doesn't make sense anymore to buy US debt. Chinese politically don't want to buy US debt. So which begs the question, if you're not going to increase the interest rate on that, who's going to absorb all that credit that you have floating in the system? So we're getting a bit off the tangent, on the tangent here with this topic. But point being is that there are many things that can go wrong. And these things aren't always a big blow up. It can be like like a balloon, basically, just, giving away air until one point something's going to give.
Yeah. Yeah. One day we get the straw which breaks the camel's back, so to speak.
Go. Yeah.
Okay, go on to my favorite asset. By the means,
well, Kaya, just before we move on to James's favorite asset, just touching on VIX and how it's trading near a very critical support level. For our traders out there, you mentioned that a bit about the equity market and the US banks, but what sort of correlation could we see with the actual US dollar currency and the actual price of the US dollar for our traders to know how they can maybe watch this to bring trading ideas?
So VIX, as I mentioned, tends to move sort of in inverse direction with equity markets. So those who know VIX technicalities, they are priced based on the put options and call options bought on S&P 500. So the more the market participants thinks that we're going to have a downturn, they're going to buy more put options, and therefore VIX is going to sort of go higher. And again, if we sort of extrapolate that thought, then US equities tend to move inversely with the dollar generally. There are exceptions, but I would say once you see VIX going up, most likely the dollar could go up as well. I'm not going to give you a correlation because I don't have a specific number, but more often than not, when VIX starts going higher, that's the risk-off sentiment, and you could see more inflows into safe haven assets, and US dollar being one of them, I think could benefit from VIX hikes.
Very good point. Very good.
Thank you so much.
Like I say, dollar is a safe haven along with the Swiss franc, yen, and of course my favorite, gold. Let's go on to my not so favorite asset now. So what's happened? What's happened to Bitcoin?
Bitcoin, another all-time high. Again, I think we're reaching 46,000 these days. Honestly, when it comes to Bitcoin, very hard to quote the price because whenever I look at the screen and I actually quote the price, it's already outdated. It's already moved 10% up and down. So clearly this catalyst now came from Tesla. So Elon Musk has said that Tesla is going to buy has bought 1.9 billion worth of Bitcoin. Which leaves, and I'm going to accept Bitcoin as a method of payment, right? So, which for me gives two questions. First of all, how are they going to mark to market Bitcoin position on their balance sheet? And how is that going to affect Tesla's share price? Because you would assume that the share price is based on the assets on the balance sheet, although, fundamentals don't matter these days. But with Bitcoin swing, I would say they have to mark to market their Bitcoin holdings. Which will be interesting, sort of. I don't think we've ever had this discussion at the global level before, like how are we gonna price a crypto asset on a large mega cap company's balance sheet? And second question, if it's a method of payment, what if the value swings so much? Are you gonna peg the value against something else? Or one day it's 46,000, then it's 30,000.
Yeah.
Who's gonna pay? Like
Exactly. But I did read an interesting piece, actually, an interesting article after obviously Tesla's made its announcement. And it was big news, and yes, the Bitcoin skyrocketed. But there was an interesting point which one analyst made, that if more and more companies like Tesla start accepting or getting into Bitcoin as a source of payment, and buying it, etc., you could see a case that there could be more stable movements. The volatility will be a bit more controlled, because obviously now it's been taken really, really seriously by the big corporations, and that could then potentially obviously keep it controlled, so we don't see such wild swings in it. I mean, Kyle, what do you think about that? Do you think that is a possibility if more companies jump on board? The volatility may always be there, but may dry up to be not so violent like we're used to?
I think it's a very valid point, meaning that the more you have long-term holders,
yes,
the more stable you can sort of expect the price to be, because the floating portion of Bitcoin will be just less and less, proportionally. At the same time, I would say until large financial institutions really embrace Bitcoin, you're not going to have that level of stability that you would expect from a storage of value or some sort of method of payment, right? So until we're going to see, for instance, some sort of fund, some sort of mutual fund or pension fund really have Bitcoin-based positions, I don't think we're gonna see much drop in volatility. And whilst Tesla is a pioneer in so many different things, I would say that it's more sort of symbolic value than really fundamental on the Bitcoin side.
Got you. Yeah.
Just to add one point to that quickly, James mentioned it briefly, but what sort of knock-on effect could we see with not other hedge funds or financial institutions, but other large companies that could maybe join the bandwagon of buying into Bitcoin like Tesla has done?
But my sort of perspective is, again, that fine, you have that on the balance sheet, which exposes you to gazillion accounting problems, which in turn may translate into your own share price volatility, because again, fundamental models do use asset values as an input. And also, how are you going to actually bill in Bitcoin if you don't have that sort of stability? However, Harry, on the flip side, I would say once we reach a level whereby a lot of large companies start accepting Bitcoin, then we could move into a new era whereby fiat money is not that relevant anymore. And I do believe that in some form, we're going to see that in our lifetimes. I'm not sure it's going to be Bitcoin. I would rather think that it's probably some sort of crypto by a central bank. And I think the ECB will be the first one.
Really? Okay. Well, like I say, I might write that down and see if you're right, and keep it for the future.
Do. In 10 years, we'll catch up for a cup of tea.
A cup of tea. Is that because I'm English? It actually is.
You're offending two of us here. You're offending two of us with that comment.
See, I killed two birds with one stone.
One stone, yeah. And I am drinking a cup of tea, actually, to be honest. So,
there you go. Before we go to Candlesticks, I want to cover a couple of more data points, and one of them coming from credit markets. Just a quick snapshot also on the S&P 500 latest earnings data. So I'm not going to go into details, but we can see there has been a lot of positive surprises on the upside. And no surprise, the main sectors that have been surprising are technology, communication services, and lastly, financials. And you might think, oh, but didn't the banks suffer last year? The trading volume and revenue for US large banks was just crazy. I mean, Goldman went through the roof, Bank of America, JP Morgan, all the same. So whenever you have volatility on the market, the big banks actually gain a lot. Although they lose on the interest income, but on the flip side, it's the sort of revenue that they get from trading side. And now we're going to jump into credit markets. So high yield issuance. So high yield, for those who don't follow credit markets, are not the safest sort of in the capital structure of a debt. First, you have investment grade debt, which is the peak of the capital structure, effectively the safest segment, normally secured by assets. And the high yield could be by companies that don't have that strong balance sheets, or maybe a lower tier level debt. Issuance at record in January, 52 billion. So it tells me two things. First of all, there's a lot of investor appetite for any yield, because we have 18 trillion of negative yielding debt, which is mostly investment grade. But also it could be that the investors really want to lock in that ultra low rate at this point, because who knows what's going to happen next year, maybe even second half of the year, if inflation should pick up. And high yield is now trading below 4%. Average is 9%. So given that high yield has this quasi-equity component, I fail to see how that actually should function as a buffer, or it just seems like we have come to a point whereby risk is completely mispriced. And investors are just taking whatever they can in order not to have negative yield. But credit markets are pricing in the reflation trade. So we have seen something called a bear steepener on the market, which means that the short-term interest have gone lower, whereas long-term interest has gone higher. So the yield curve looks slightly steeper, and that reflects effectively the increased inflation expectations for the tail end of the yield curve. So the reason why the yield goes higher is because the price of that debt goes lower, and the price of a debt goes lower if we have very high inflation in the economy. So the bear steepener means that the bond market participants are also buying into this, we're going to have crazy economic growth and we're going to have a lot of inflation, which I would be a bit doubtful about. Italian 10-year record low 0.5. Super Mario saved the day, basically. So looking at the yield between the US 10-year, it's again quite remarkable. S&P 500 has reached to a point that 20% of companies are zombies. They can't pay their interest payment from their operating income, so they keep issuing more debt. Which is my first point, that we had record issuance. So we're just going round and round and round with the same data points after every webinar.
20% is quite a large percentage for the S&P 500, though, isn't it?
Yes, it's huge, to be honest.
It is. That's very worrying, really.
It's very worrying, Okay. And again, we've had this discussion that the zombification of US companies leads us to deflationary situation, because those companies still use resources. They still use labor, they still use capital, and they sort of force the prices lower by not exiting the market. So it's very hard to actually pick up inflation if you don't have some companies just basically eaten out. And then one comment about the bear steepener ties back to this US 2-year and 30-year yield spread has now reached 1.04, which is the highest since April 2017. So basically markets are looking into the future as they did back in 2017, which was very, very much a risk-on sort of market environment. Oil has picked up at 58.6. At the back of OPEC cutting 1.2 billion worth of supply in terms of barrels, and also I think we have seen quite cold temperatures in North Asia, North America, and North Europe, which sort of increases the price of energy.
Quick question on oil, because obviously you've got Brent, which is high. We mentioned earlier on about the optimism of the bullish market, and obviously oil, like you said, is benefiting from the cold winter months, and obviously OPEC, but is also no doubt benefiting from the optimism of things can go back to normal growth in manufacturing and things like that, airlines and stuff like that. So that's obviously one of the reasons why it's also benefiting. But again, like we said, like with the market earlier on, when the reality sets in that there's no more further good news and more negativity, do you think that obviously oil is going to be one of the first things to really show that, we are potentially looking at a downturn on the market across the board?
I think oil will take some sort of hit when the expectation changes. And you are very rightfully, giving the rationale that once we are pricing in the reflation and reopening of the economies, we're going to see, and we have seen price picking up. Also, China recovery. So China is one of the main consumers of oil as on national level. So China has bounced back quite well. If they continue on the same sort of growth trajectory, oil will be supported by demand and lower supply. But at the end of the day, I think a lot of it still comes down what Saudi Arabian government is doing.
Right. Fair enough.
We'll see.
Fair enough.
I would rather think that oil is going to reach maybe mid-60s and potentially even touching 70 before we actually come down to whatever level at whatever time point, because these days very hard to make any sort of market projections.
Okay, interesting.
Yeah, and what's interesting is that oil has reached that level while US dollar has also been strong. So US dollar has changed its direction after the Georgia runoffs in early January. So it broke 50-day resistance, and now the 50-day resistance has become sort of a support level. So we'll see how dollar continues to behave. But again, looking at the relative growth in the US versus the Eurozone, looking at the relative stimulus at the fiscal level, and maybe I want to say tapering, but I'm just going to say maybe the slightly suppressed liquidity from the Fed, these all support stronger US dollar, for me at least. So I would say one of my conviction trades for 2021 is a stronger US dollar. And I think that was also reflected during our year-end discussion when we had Mr. Riyadi on. So most of my projections were stronger dollar and weaker local currency.
Okay, well, I'll look at that. I've always got it on my desk here, actually. What was it? Gold. This is till May, though, so you still got a bit of time.
Yeah, I think March. No, what did we say? March?
I think we said May. I can't remember. We'll say March because the cable you had it at 131.54. What do you say about that, though?
Oh,
there you see the cable, huh?
1.3
trading at 138 today.
Yeah, exactly. Cable reaching another swing high, which is again remarkable how the market actually reacts.
Yeah,
it's weak economy. Poor labor market.
Yeah,
nothing in favor except for the vaccine.
Yeah. Exactly, vaccine, and I think like we said, like with the market, like with oil, once the excitement is finished about the Brexit deal finally pretty much being done and the vaccine, the reality will set in. There's no jobs, there's no growth, and then it will. Yeah. Anyway,
then it will come crashing down. Yeah,
exactly.
We'll see.
Exactly.
I want to touch upon the last point I have here, which is about U.S. Congress approving the budget resolution for 1.9 trillion. So I'm not an expert on U.S. politics, but with this latest process around budget and reconciliation, I actually went into the weeds and trying to figure out what's going on. Are we going to get the second stimulus as well?
Yeah.
So this 1.9 trillion was effectively approved along the party lines. It went through budgetary reconciliation process, which means that you need only majority in order to get this approved effectively. So we had 51. The tie casting vote came from Kamala, and all 50 Republicans said, nah, we're not going to approve this budget, right? So this process can only be done once in a fiscal year. So for 2021, no more voting, along party lines. You actually need supermajority in the Senate. So if Joe Biden wants to push through his second stimulus, which he has said is going to be funded through tax hikes, you would need at least 17 Republicans approving tax hikes in order to push through the stimulus that Democrats want to have. Now, what do you think, James and Harry? How likely it is that the Democrats are going to go for tax hikes and in order to satisfy Democratic stimulus plan? I should say Democratic Party stimulus plan.
Well, Republicans love tax cuts, don't they? So
they love tax cuts, but not tax hikes.
Exactly. So tax hikes, I cannot see them backing Biden on it, and for obvious reasons, because they don't like to help each other, do they? Do things. So that's going to be a big. We said this back in January as well. To be fair, that Biden's biggest challenge is all the obstacles he's going to get into place trying to get things through. So this could potentially cause a major fly in the ointment then, if this is going to be a major factor. Yeah, so this could be the beginning, like you said, and maybe, as we said on the previous slides, of the market waking up and going, oops, things aren't so good. What do you think, Harry?
Well, to be honest, I agree with you, James. At the end of the day, we could see him facing quite a lot of resistance, trying to push a lot of things through.
Yeah.
It was very nice seeing him on the first day trying to revert most of Trump's works. So that was always very interesting. But no, I agree with you. I feel like he could face some challenges along the way, and it could be very difficult for him to find his ground very early on.
I think more likely than not, this second stimulus is not going to go through, which means all that priced in expectations into infrastructure, into green energy. I can't remember what else was there, but I think the focus was around green energy and mostly and the infrastructure. It's not going to happen. No. So no way in 2021 any Republican is going to say, fine, give us the tax hike and we'll approve your stimulus plan so that you can get your votes. And on top of that, I'm not even sure if the Democrats themselves are going to go for tax hikes, given that a lot of them are up for a mid-season election in 2022,
by-election type thing. Yeah,
it's not that far, right? I mean, it's basically here. So so the stimulus more likely than not are not going to come. And I think that another potential catalyst for the markets to take, downturn.
Absolutely. Again, like we said earlier on, this is one of the reasons why the market got excited and got bullish. And now, if that reality sets in that it's not happening, it can then really kickstart what we could say could be a potential downward spiral. Anyway, so we move on to a little bit about the subject today, which is obviously the candlesticks.
Let's talk about the subject today. Yeah. So I think about a month ago, we did our first session on candlesticks. Yeah. We did a very basic one. We went through 5 of them. We're just going to do a recap of 3 of them today. And then we have Harry, who is dare I say, an expert when it comes to technical analysis. And he will walk us through a few of the charts just to explain how to apply candlesticks, because that was the feedback we got from viewers. Great, thanks for showing us, but what am I supposed to do with that? So we're going to cover today a hammer, which is a sort of reversal candle, which is going to show us hopefully potential direction upwards. We are going to cover, the next one is 3 white soldiers, another very nice bullish sort of signal. And the last one we're going to talk about is the hanging man, so sort of the inverse of the hammer. So yeah, with that, I'm going to give the floor to Harry.
Thank you very much. So if you can look at my charts now, we'll just pull them up on the screen. As Kai said, one of the first candlesticks that we look at in the market and when we trade is the hammer candle. It's one of the most basic candlesticks that we look at. And one thing that many people need to understand is that it works in both directions. You can have a hammer candle and an inverted hammer candle. So looking at the market right now, as you can see on my screen, we've got gold up on a 1-hour chart. The reason why I love candlestick patterns is because all of my traders ask and they struggle with entry points. And these candlesticks and being able to spot them will really be able to help you identify better and clearer entry points. So looking at the first one here, the hammer candle. As you can see on gold, we actually have a inverted hammer candle here at the bottom of a very nice downwards trending market. This inverted hammer candle came at a perfect time because, as we can see, it's got a very short body, a very nice long wick, and it was the bottom of a downward trending market. So that's exactly what we're looking for the hammer candle. And as we can see, the market then took a nice little bounce and started actually coming nicely upwards, and a nice bullish market started after that.
So you would, Harry, use this as an entry and an exit both?
Correct. So if I'm a trader in the market right now, and let's say I've got a sell position on the bearish trend of gold coming down here, I could see this candlestick as almost a signal to get out the market. Now, we have to understand that this is a potential signal. It doesn't guarantee anything, but it's a nice indication for me to know that, okay, I've made some profits from the sell trend. This is a worrying sign now. So maybe let's cut our profit short, not get greedy, take our profits, and now maybe even look to catch the upward movement if we do see it happening.
Brilliant.
Okay, so now
Good thing
moving
is it's
on.
very easy to pick up this one. I mean, I don't know what about you, but I find this one of the easiest to sort of pick up on a chart.
Well, it's why it's one of the first ones you'll learn, because they stand out a lot more than others. With their significantly bigger wick to the body, they do kind of stand out all across the market. So no matter what you're looking at, if you find that very big wick and small body, you could have a very nice indication of the next moves into the market.
Okay, makes sense. Harry, what else are you going to show us?
So the next one I do want to just brush upon is the 3 white soldiers. So as we can see here, the 3 white soldiers, I've got the Euro US dollar chart open on a 1 hour time frame. Now with the 3 white soldiers, the thing we look for is a 3 candlestick period. We need long bodies with small wicks, and the bodies increasingly bigger and higher highs and higher lows. Now, as we can see with this downward trending market on the Euro US dollar, it hit a very nice bottom level where we could see the potential reversal. We did start with 3 very nice candlesticks, all of them increasing with very minimal wick and all body. And we can see the higher highs and higher low pattern here, even if I zoom in a little bit.
Brilliant.
Just to see that we can see that each candlestick has opened and then shut up, opened and then shut up. And this is almost confirming the 3 white soldiers. And as we can see, even till right today, the market is continuing the upward trending market. And since that candlestick pattern, we've already seen the market move up 180 pips.
Brilliant.
Harry, but how would you identify? I mean, for the 3 white soldiers, would you wait for the 3rd, or would you wait even for the sort of candle to close and then either enter or exit as per your view? How would you read that?
So personally, I always wait for the candlestick to close, as this is the confirmation of the movement of the price during that period. So if you're trading early or you're not waiting for the candle to close, you could be rushing your entry, and you could see this candlestick changing very quickly, which will then not be the 3 white soldiers, and you could have ruined your entry point. So it's very important to wait for the closure of the candlesticks, wait to almost tick off that little checklist to make sure that you've got everything you need to then proceed with your trade in the market.
Cool, excellent. Makes sense.
Wonderful. So then the next one I want to actually go into is the Hanging Man.
What a lovely name that is.
One of my favorite. So the Hanging Man one, again, is a very nice candlestick because similar to the hammer candle, is pretty obvious to spot in the market. Again, we're looking for a big body, a very small wick. The difference is here, this is more a bearish equivalent of the hammer candle. This normally forms at the end of an upward trending market. And this is often where we see the sellers dominating the buyers. So as we can see on the US dollar Japanese yen, we had a very nice upward trending market for a couple of days until we got a very nice confirmation at the middle of the 8th of February with that Hanging Man candlestick. And as you can see, the market did not waste this time. Straight away after this, we had a solid rejection at this level, and we've seen the market even continuing its downwards trend, dropping over 120 pips in the market.
But Harry, tell us your approach. Would you trade purely based on candles, or how do you build your thesis when you actually trade? Do you use candles as a confirmation, or are they sort of your main source of info and let's say trading idea?
So personally, I like to almost generate my own signals in the sense that I like to collaborate quite a bit of information together to try and almost have all the stars aligned. Once we have 1, 2, 3 different, let's say, areas in the market that are all showing us a potential buy, a potential sell, we're knowing that we've got a bit more confirmation for this. So if I'm looking at the market, I will also look at whether the market's trading near a support level or a resistance level. I will look to see if the markets are overbought or oversold. The beautiful thing about the Hanging Man, in my opinion, is that where it's on a bearish market and it normally comes at the, let's say, the top of a sell-off, often markets might even be overbought at this level. So if you're looking at, let's say, an upward trending market like here, once the markets reach here, if the markets are overbought based on an indicator, then we also get the Hanging Man candle. That's now 2 independent indicators into a potential sell market. So you're almost adding certainty to that trade, and you're just giving yourself maybe a little bit more chance for success in that trade.
Harry, yes, my approach is actually similar. So the way I build my sort of entries and my trade ideas, I look at a bunch of different indicators. For me, moving averages, it's the RSI stochastics, where I sort of synthesize everything together. And then I look at the candle, if I can see any that may confirm or just reject my thesis. So sort of, I think we're more or less on the same page that candles are never sort of the primary data point or the catalyst. It's more just confirming the story or rejecting whatever I have in mind.
Exactly. I mean, the more information we take into account, the better it's going to be for us. If we can take into 1, 2, 3, 4 bits of information, hopefully that will give us a bit more certainty and confidence to enter the market, rather than maybe rushing an entry point, misjudging the market and the direction of the market, which could lead to a loss in our trades. So better to be confident, be certain, wait for that confirmation, add it all up, and then proceed with the trade.
As you often say, Harry, as well, best traders are the patient traders.
Exactly.
Yeah.
Perfect. So I just wanted to also show one more pattern here. This actually happened in today's market, and it was an opportunity I personally took myself. This is the Great British Pound against the Japanese yen. This was a very nice open, and we saw quite a nice hammer candle happening relatively early on in the day, around 9 a.m. this morning. The markets were coming down, almost looking like it's starting a downwards trend. We had the little hammer candle, as we can see, a very nice body, a very long wick. Just to confirm this a little bit more, let's zoom in. As you can see, a nice body here, the long wick over double the size. And as you can see, again, market did not waste this time. As soon as we had the confirmation of that close, markets then shot up as high as even 55 pips.
That's a brilliant textbook example.
Textbook trade, exactly. It's one of them ones that you look for and you're like, you never actually catch them live.
Yeah, brilliant. Very good.
Lovely. Do we have any questions at this point, James?
Let's have a little check. I don't think we have. We have one question, which is basically what is the best candlestick pattern to use? But again, I think we've covered a lot. There's so many different ones for different opportunities. It's not looking out for one in particular. It's looking for as many you can recognize as possible. We've got no questions at the moment, but I tell you what I would like to do. As we have Harry on board tonight, or on board today, like we did with Addy, I want to do like a little wager between the two of you, just for the fun of it. For those of you who saw our end of year show, you know the rules. I'll give you an asset, both of you, and you both have to decide roughly where it's going to be in, say, 2 months' time. As we know, we did one previously with Kaya on the cable, 131.54. Where is it at the moment? Where is it at the moment, Harry?
Well, let's get the chart up. If we're looking at the GBP USD right now, it's trading at 138.44. So as you can see here, the market is trading relatively nice.
A bit of time, okay, bit of time.
I think you're counting your chicks a bit too early here. Give me a bit of time, and the cable will come down.
We'll just have to see. So anyway, this time I'm going to choose 2 assets where I want a number from both of yourself, and I'll write it down and we'll save it. So the first asset I've chosen is one I can't stop talking about because I love it so much, and that is Bitcoin. Where is Bitcoin going to be roughly in 2 months' time? I start off with ladies first, of course. Kaya.
So I am going to do the educated guess. I'm going to open my charts in parallel just to see. I mean, Bitcoin can be, toss of a coin, right? It can be one way, it can be the other way. So it's very, very hard to say. So we say 2 months. Is that the time framework?
2 months, yeah. Let's say middle of April, end of April. So
end of April. Okay. Honestly, looking at the charts, it doesn't even make any sense. However, I shall say it's going to be 34,500.
34,500.
518 for the sake of it.
So 34,518. Okie dokie. Right, Harry, same question. Where do you see Bitcoin by the end of April?
Well, I'm actually going to go for the opposite of Kaya. Looking at the charts now, on the basis that Tesla is so heavily invested into it, and if they do start the production of actually using Bitcoin for a payment for their cars and their products, I reckon this could actually catch some good headwind for Bitcoin. So looking at it now, it's around 44,000. By April, I could be seeing maybe closer to 50,000, 55,000.
So which one are you going to go there, 50 or 55?
Let's go in the middle. 55,555.
Wow, nice number.
5.
That's exactly where we're going.
Okay. All right. Okay. So here we go. This is the.
I love the fact how we both have some sort of rationale behind it, and we're trying to rationalize this in our brain. What could make sense?
We're trying to think we make sense.
But the reality is 58% gain within the last 5 weeks does not make any sense. So
you can't deny it.
True. So here we have it. Kaya at 34,518 and Harry at 55,555. Right, there we go. So it's written down. So the next asset I'm going to choose, I'm going to do one more. We're going to go for the S&P 500. Where do we see S&P 500 by the end of April? Ladies first again, Kaya.
I am going to say... Not pricing in any market events, but I'm going to say it's going to be 3,800.
800.
Currently at 3,888 for those who are looking at S&P.
Yeah. Okay, Harry, where do you see the S&P 500 by the end of April?
Well, the good thing is that we are seeing new highs almost on a daily basis with the S&P 500, regardless of the fact that, as we mentioned earlier, 20% of the companies are zombies. We're still seeing some nice strength with the S&P 500. We have seen a nice little cool off though, so I'm actually going higher and saying that by April, and this time around April, we could be seeing it really trying to test the strong resistance around 4,000, that psychological level, trying to enter a new ballpark and really trying to push higher.
So you're going to go for 4,000?
I'm going to go for 4,001. Yes.
4,001.
Okay, interesting.
Yeah, so confirmation of the breakout of 4,000.
Market. Talking about market structure and sort of technical aspects of it. Institutions do rebalancing at the end of every quarter, which means that they pull back into their respective weights. If equities have been performing extremely well, they're going to sell equities portion and buy fixed income. Not to say that invalidates or validates our thesis, but just an interesting market sort of structural data point that whoever invests in equities at the end of every quarter, you have to be mindful because there's some increased activity happening at institutional level.
True. So go on, Harry. Sorry, go on.
No, Harry. I was going to say, just to add to that, because if we review, let's say, the same period of last year for the S&P 500, it does look like it also had a nice strong trend throughout April. So even though that we have the figures being released and we have this, I still think that we could see it break in new highs.
Well, fair, Harry, I agree. However, last year in April, we came from record crash, which was on the 23rd of April. So, but I agree with you. The sentiment is still there. I mean, my entire presentation just confirmed the same story, that we still have risk on sentiment. So, but yeah, that's the fun part about 2021, that nobody knows and nobody can rationalize. We all just, pulling ideas and maybe this, maybe that.
Yeah. Well, okay, but both are really good. So I've written it down. Okay, obviously, so we have Kaya 3,800, and Harry with a very optimistic, very bullish expectation of 4,100. So there we are. We're booked in. Just very quickly, ladies and gentlemen, don't forget this little game is for a bit of fun, and in no way whatsoever should be taken as trading advice. So we're not advising you to where we actually think things are going to go. Right, while we wait for any questions, Kaya, do you want to give the good people a rundown of what we got coming up in later episodes?
So next week we are going to do a second session about recognizing patterns on the chart. Again, similar what we did today. We're going to pull up the chart. We're going to show you a pattern just to train the eye how to see those sort of formations on the charts. The following week we are going to do James's special around correlations. So we're going to talk about major pairs, correlations between these.
Yes.
And for the month of March, we are still brewing our plans at the back of the sort of feedback we got from every one of you during our poll last week. So please expect announcements. We're going to send maybe a couple of emails just to let us know what's the plan for March. But next coming days, we're going to have a March and an April plan in place. And if you have any ideas, any comments, any feedbacks, please drop us a line.
Absolutely. That just to underline that point, don't forget, like I say, these shows exist for you good people, and the subjects we choose to discuss are suggestions by yourself. So please keep your ideas and suggestions coming in, so we make sure that the material we produce and present is exactly what you need and exactly what you want to learn. Okay, guys, we have no questions currently at the moment. So on that point, Harry, it's been an absolute pleasure having you on the show. You fancy coming back next week?
I'd love to be back. It's been an absolute honor being here. I've enjoyed it. I've loved it. And the more I can get involved, the more we can let everyone know what's going on.
Well, I think if you behave yourself, we might let him back next week. What do you think, Kaya? Should we let him back?
We need at least one gentleman with a tie, James.
Someone has to dress to impress.
Right.
So Harry is coming back.
Excuse me.
Okay, Pocket Square, fine. You get a bit of a discount. So Harry, looking forward to having you on our show more often, because again, you are the sort of expert when it comes to technical analysis, and I find it's good to have a bit of on the ground views, because you also speak with our clients.
Of course, well, anything to help our clients, anything to show them that we're doing this regularly and we're here to help them, and we're here to actually spread more information and just to really make everything as smooth as possible.
Perfect. Absolutely right.
Sounds great.
On that note, should we say goodbye to our good people?
Let's say goodbye. Thank you, everyone, for joining. We'll see you again next Wednesday.
Yeah, and
thank you for joining.
Yes, and thank you everybody for joining us today. Now remember, these little live shows of ours are for educational purposes only and should no way whatsoever be taken as advice. I always suggest you do your own research and do your own due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you out there, trade safe.